Okay, AP Macro, so these are the practice problems that align with Mod 41, talking about both the current account and the capital account, hopefully helping to show that you can graph capital account changes using a loanable funds model, but also that you can connect the capital and current accounts and how these things interact with each other. If you have not done these problems already, you should either pause this video as we approach each problem and make sure you attempt the problem first, or make sure you go find the Google Sheet or Google Doc and complete the problems in advance. It is really important that you complete the problems before you watch the solutions so that you can really check your own thinking and be aware of your own thinking along the way. So pick one of those two options, but here we go. Problem number 1, due to an international financial crisis, Canada experiences a significant inflow of funds from other countries. Explain the effect that this inflow will have on each of the following. So first, what's going to happen to the real interest rate and the level of investment in Canada? Let's use our loanable funds market. So we'll start by saying that inflow represents an increase in the supply of loanable funds. We can drop in our starting interest rate here, RE, and our starting quantity of loanable funds, QE. An increase going to SLF2, created by an inflow of funds, is going to lead to a decrease in our interest rate down to R2, and an increase in our quantity of loanable funds. So we can say that the real interest rate in Canada is going to decrease. Second half of this question goes back to something that we have studied in past units. When interest rates go down, we know that investment spending will go up because borrowing is cheaper. This also relates to the idea that the return on investment will increase as there is a decrease in the real interest rate. In other words, businesses are going to be able to make more money on their projects as those projects become cheaper when the rate of borrowing decreases. So we've got a capital inflow, we've got an increase in the supply of loanable funds, we've got an increase in investment spending, and a decrease in the real interest rate. Those are our answers to part A. Part B is a classic follow-up to this kind of a question, and it is a little bit tricky. There are kind of two solutions here. So what's going to happen following the inflow of funds to Canadian net exports? And there are two ways that you could answer this. The first, the kind of really simple way to answer this, is that the inflow, of course, is on the capital account. So we know that the capital account is increasing or moving into a surplus. Meanwhile, net exports are on the current account. And we know that those two accounts have to add up to 0, or they have to be opposites. So if the capital account is increasing, then the current account must be decreasing. So we can say that net exports will likely decrease. The second explanation for this kind of builds on that idea. And maybe is the proof of that concept a little bit more. If you think of in a country experiencing an inflow, right? If there is inflow, then we have Canadians have more dollars or have more money to spend. And when Canadians are wealthy and have more money to spend, then we know that naturally, or we can assume that naturally, their level of imports is going to increase. When you go to Target, when you go anywhere and buy something, you are likely buying, at least in part, an import. So as people have more money, and this is a relationship that's going to become more and more important in this part of the unit, but when people have money to spend, they spend that money on imports, which means that net exports will be decreasing. And we get the same answer here with both explanations. When a country experiences a capital inflow, then their net exports have to decline to balance out that capital inflow. Okay, so that's number 1. Let's scroll down a little bit here. Number 2 If you, again, have not yet done this problem, then pause right here and pick it up in a moment when you are ready. This one starts, old FRQ from the AP exam. There are two sub-accounts, the current account and the capital account. First one, straight what we've done in past days. Where do each of these items belong, current or capital account? A U.S. resident buys chocolate from Belgium. Chocolate is an import of a good. An import of a good appears on the current account. And just for good measure, we can say that that is going to be a debit on the current account, or the current account will go into a deficit. Second one, slightly more tricky. U.S. manufacturer imports computer equipment. Sorry, didn't mean to do that one. Imports computer equipment. The key word here, though, is that they actually import the equipment. So again, we have the import of goods. Does not matter if those goods are physical capital for a business or if they are kind of private non-durable goods like chocolate in the prior example. So import of a good is again on the current account because the current account includes net exports. And again, the United States is doing the importing. So for the United States, that is a debit on the current account. Second problem brings us to the relationship between current and capital again. We have two debits, so we have the current account is going into a deficit, or the current account is going to be negative. Assuming foreigners find U.S. goods to be too expensive, how would these changes affect the flow of capital to or from the United States? So we have in part one, the current account is negative. So we have dollars flowing out of the United States for imports. And if we assume, as we're told here, that foreigners don't want to buy American goods, then what is the only thing foreigners can do with American dollars? Right, so we can say that foreigners will buy U.S. assets, which is capital inflow. And capital inflow, of course, means that the capital account will go positive or into a surplus. So we again have the same relationship. Current account is negative, so the capital account should go positive or into a surplus. And again, this should make sense. We are giving a lot of dollars to people, in this case in both Belgium and in Japan. If the people in Belgium and Japan do not want to spend their dollars on our goods, then the only place they can spend our dollars is on our assets, which shows up as capital inflow into the U.S. capital account. Number 3. Again, pause here when you need to, and complete this problem in advance. This again is a classic relationship similar to number 1 that we need to start getting used to. Real income of U.S. households increases. So people in the United States are making more money. How would this affect the balance on the current account? So what we can really say here is that U.S. citizens are wealthier and have an increase in real income. We can translate this to the current account, and we can say that there's going to be an increase in spending in the United States, which is going to lead to an increase in imports, similar to what we said with Canada in problem number 1. Again, sometimes students have trouble wrapping their head around this one, but the bottom line is that when people have money, they spend that money, and in a modern globalized economy, they're going to spend some of that money going to buy goods from other parts of the world. And again, almost anything you buy in the United States includes at least a partial import, so that's going to show up as an increase in imports. The other example I always like to say here is when people in America make more money, they take vacations. And when they take vacations, especially if they're vacations to other parts of the world, that counts as an import. So when imports go up, we can say that net exports are decreasing, and we can say that a decrease in net exports leads to an increase, leads to a decrease in the current account. A frequently asked question on this one that pops up, students sometimes ask, wait a minute, but what if the American citizens only buy American stuff, which kind of, first of all, doesn't happen, but secondly, when C increases or when I increases, which would both also happen, right? These are also both results from more wealth, from an increase in income in the United States, but those do not appear anywhere on the balance of payments. They don't appear on the current account because the current account only measures foreign transactions. So when American citizens make more money and they buy more American stuff, that has no effect on the current account. So the only part of this that will affect the current account is that some of these purchases by American citizens will include imports, which will lead to a lower current account. And then, once again, getting back to the relationship between the current account and the capital account, how would the change above affect the net inflow of capital to the United States and the real interest rate? So if the current account goes negative, then we know that we have to have a surplus on the capital account. Surplus on the capital account should be inflow, which is an increase in the supply of loanable funds. So we can come over here and we can increase SLF to SLF2, which is an inflow. There's more savings from the rest of the world. And that is going to lower the real interest rate. And we can see the decrease in the real interest rate down to R2, caused by this rightward shift of the supply of loanable funds, right? More dollars coming into American assets means that American businesses don't have to pay as much to get those assets or to get the money in return for those assets. So American households get rich, American households buy more imports, and that leads to a negative current account, which will result in a return of a positive capital account. This, by the way, relates a lot of it, to what we saw in the question about, does the current account matter, or should we care about the current account, right? If our negative current account is caused by the fact that we are a wealthy economy, and as a wealthy economy our people like to buy things from all over the world, then that negative current account is not necessarily a bad thing. It's actually, the negative current account here is an indicator of strength in our economy. And similarly, that negative current account indicating strength leads to our positive capital account, that people like to give us our money back and like to let us use our money, and let us use our money so that we can buy things for even less. And so that goes back to this idea of whether we should care about our current account in the first place. All right, lastly, number 4, one more time, pause if you haven't gotten here. This one is a little more complicated. It starts to link a few units together, but a super valuable thing that you should be able to do with your capital account, current account, and loanable funds model. So a country's economy is below full employment, has balanced trade. Balanced trade here, we're going to read that to say the current account equals 0, which means the capital account equals 0. It does not mean there's no trade happening, just means that both of those things are coming into balance with each other so that there is no surplus or deficit, right? The government lowers taxes and runs a budget deficit. Now, first of all, anytime you see the words budget deficit in this course, you should immediately think of crowding out, especially if it's in reference, as we see here, to the loanable funds market. So we come back to a deficit on the budget. We are going to show this as a decrease in the supply of loanable funds. We say that the government is dissaving. They are gobbling up savings that could have been made available to businesses. And so the actual level of savings in this economy is going to decrease. So the answer to letter A is that when we have a budget deficit, the supply of loanable funds decreases. That leads to an increase in the interest rate and a decrease in the total level of loanable funds occurring, right? So the decrease in the supply of loanable funds leads to an increase in the real interest rate. That is our answer to letter A. Letter B is where we now jump over to our current and capital account. How would the change in the real interest rate affect the balance of payments on the capital account? So when interest rates go up, especially real interest rates go up, we know that that leads to capital inflow, right? Foreigners seek higher interest rates. So foreigners say that, or see that the United States needs to borrow a lot of money. They see the United States offering very high interest rates, and they begin to send their money to the United States to fund those purchases at higher interest rates. So inflow is a positive on the capital account, or the capital account is positive or in a surplus. And lastly, based on the response in part B, so given that the capital account is going positive, explain the effect on the economy's net exports. Well, if the capital account is increasing, then the current account must be decreasing. And again, if you watched anything having to do with the question of whether we should care about our current account deficit, there were a couple radio programs that said that deficit spending is actually a big driver of our trade deficit, right? If our government overspends, then they need to collect that money for assets somewhere, which is going to be the capital inflow. And that capital inflow and that spending by the government is going to lead to Americans buying more foreign products than foreigners are buying of our products. So we see a traditional kind of paradox, right? The more the government spends, the more money is moving in the US economy, but that also means that Americans send their dollars out to buy goods and services, negative current account, and that foreigners then fund our deficit via capital inflow. So the biggest things, again, you should be able to do here, notice consecutively, capital account and current account are inversely related, and you should always be able to grab that inverse relationship. By the way, I really should be more specific, as I noticed down here. Current account goes negative, that means net exports are decreasing, right? More imports than exports is the more specific answer to this, right? So thing number one, we should be able to always show the relationship between the capital account and the current account, show those as inverses. And item number two, consistently be able to show how the capital account, either going positive or negative, appears on our loanable funds market using the supply of loanable funds. All right, happy studying. Send your questions my way.